clicked on the one video that's going to save you from every credit card mistake people spend years recovering from. If you've ever looked at a credit card offer and felt like you were reading a different language, or if you've ever wondered why some people seem to build wealth with credit cards while others end up buried in debt, you're in exactly the right place right now. Because here's the truth nobody tells you when you turn 18 and suddenly start getting credit card offers in the mail. Credit cards aren't dangerous. Ignorance about credit cards is dangerous. And by the end of this video, you're never going to be that person again. Most beginners think credit cards are basically just a convenient way to spend money you don't have yet. That's the story. Swipe now, pay later. And that belief, that one simple misunderstanding, is why the average American carries over $6,000 in credit card debt and pays hundreds of dollars every year in interest on purchases they've already forgotten about. But here's the contrarian truth. A credit card, used correctly, is one of the most powerful financial tools a beginner can have. It builds your credit score, gives you purchase protection that your debit card doesn't, earns you cash back or travel rewards on things you were already going to buy, and it costs you absolutely nothing. As long as you know the 3 rules that separate people who win with credit cards from people who get destroyed by them.
I've watched people go from zero credit history to qualifying for premium cards with massive rewards in under 2 years, just by understanding the fundamentals I'm about to walk you through. And I've watched smart, disciplined people wreck their finances because nobody taught them what I'm about to tell you. Here's the plan. We're going to start with the one thing that trips up almost every beginner, and it's not what you think. Then we're going to break down exactly how credit cards actually work, because the math is where people lose. After that, we're going to talk about how to pick your very first card the right way. And we'll finish with the habits that make credit cards work for you instead of against you for the rest of your life. Let's start with the thing that destroys most beginners. And it's not overspending. It's misunderstanding the billing cycle. Your billing cycle is the period of time, usually about 30 days, during which your credit card tracks everything you spend. At the end of that cycle, your statement closes. Whatever balance is on your statement on that closing date is what gets reported to the credit bureaus as your balance. Then you have a grace period, typically around 21 to 25 days, before your payment is actually due. Here's where beginners get it wrong. They think the due date is the only date that matters. It's not. The statement closing date matters just as much, maybe more, because that's the snapshot of your balance that goes on your credit report. If you're carrying a high balance on your closing date, your credit score takes a hit, even if you pay the full bill on time a few weeks later.
So here's what you do. Know your statement closing date. Make it a habit to pay down your balance before that date, not just before your due date. Keep your balance on the closing date below 10% of your credit limit, ideally as close to 0 as possible. That one habit alone will build your credit score faster than almost anything else a beginner can do. Here's a real example. You have a $1,000 credit limit. You spend $600 during the month. Your statement closes with a $600 balance. That's 60% utilization reported to the bureaus, and your score drops. But if you'd paid $550 of that balance before the closing date, only $50 shows up on your report. That's 5% utilization. Your score goes up. Same spending, completely different outcome. And here's why this matters in the bigger picture. Credit utilization, how much of your available credit you're using, is 30% of your entire credit score. That's almost a third of the most important financial number you'll carry for the rest of your life. Getting this one thing right from day one puts you miles ahead of people who've had credit cards for years and still don't understand why their score won't move. That's the foundation. But if you don't understand this next piece, the foundation means nothing, because this is where the money actually disappears, how credit card interest actually works, and why it's one of the most expensive traps ever designed. When a credit card company advertises a 24% APR, annual percentage rate, most beginners hear that and think, okay, 24% per year? That doesn't sound too bad. But that's not how it works in practice.
That 24% annual rate gets divided into a daily periodic rate. So 24% divided by 365 days is about 0.066% per day. Every single day you carry a balance, that percentage is being applied to everything you owe. And interest compounds, meaning tomorrow you're paying interest on today's interest. It stacks on itself quietly every single day until you pay it off. Here's what that looks like in real numbers. You put $1,000 on a card with 24% APR. You make the minimum payment every month. Let's say it's $25. Do you know how long it takes to pay that off? Over 4 years. And do you know how much you'll have paid in total? Around $1,400. You borrowed $1,000 and paid back $1,400 for something you've probably already used, worn, or forgotten about. That's not a loan. That's a penalty for not understanding the rules. The solution is almost embarrassingly simple. Pay your full statement balance every single month before the due date. Not the minimum payment, the full balance. When you do that, you pay zero interest. Zero. The grace period protects you completely. You get all the benefits of the card, the credit building, the rewards, the purchase protections, and the bank gets nothing from you. That's how you use a credit card like a tool instead of getting used by one. Now that you understand how the billing cycle and interest work, you're ready to actually pick your first card. And this decision matters more than most people realize.
How to pick your first credit card, and why most beginners are choosing the wrong one. The most common mistake beginners make is going straight for the flashy rewards cards, the ones promising 3x points on travel, airport lounge access, and big sign-up bonuses. Those cards sound incredible, but most of them require good to excellent credit to even get approved. And if you're just starting out, you probably don't have that yet. So here's the actual path. Your first card should do one thing: get you approved and start building your credit history. That's it. Rewards come later. Right now, you're playing the long game. If you have no credit history at all, start with a secured credit card. A secured card requires you to put down a cash deposit, usually $200 to $500. That becomes your credit limit. It works exactly like a regular credit card. It reports to all 3 credit bureaus, and after 6 to 12 months of responsible use, most issuers will upgrade you to an unsecured card and return your deposit. Capital One, Discover, and many credit unions offer solid secured cards with no annual fee. If you're a college student, student credit cards from Discover or Bank of America are specifically designed for beginners with limited history and are much easier to get approved for than standard cards. Once you've had your starter card for 12 to 18 months and built a score above 680, that's when you start looking at cashback cards. Something straightforward like the Citi Double Cash, which gives you 2% back on everything. No categories to track, no point system to decode. You buy things, you get money back. Simple and powerful. And here's why the sequence matters. Every card you apply for creates a hard inquiry on your credit report, which temporarily dips your score. If you apply for 4 cards trying to find one that approves you, you've done more damage than the card will fix in 6 months. One strategic application beats 4 scattered ones every single time.
And now the habits, the ones that make everything else actually work for the rest of your life. Habit 1. Treat your credit card like a debit card. Only charge what you already have the money to pay for in your bank account.
The card is just the vehicle. Your bank account is still the budget. This one mindset shift eliminates 90% of the debt risk that beginners face. Habit 2. Set up autopay for your full statement balance every single month. Not the minimum, the full balance. Do this on day 1, the moment you get your card. Then you never have to worry about missing a payment, and you never accidentally carry a balance into the next cycle. It becomes automatic. Your credit score grows automatically. Your financial life gets easier automatically. Habit 3. Never spend more than 10% of your limit in any given billing cycle if you can help it. If your limit is $500, try not to let your balance go above $50 before you pay it down. This keeps your utilization low, your score growing, and your habits tight while your limit is still small. Habit 4. Check your statement every single month. Not because you're paranoid, but because fraud happens, errors happen, and the people who catch them fast are the ones who are paying attention. You have zero liability for fraudulent charges on a credit card in the United States as long as you report them promptly. That protection doesn't exist on a debit card. It's one of the most underrated benefits of using credit over debit for everyday purchases. If this video helped you, hit the like button. It genuinely helps this channel reach more people, and it takes you 1 second.
Subscribe if you want the follow-up video I'm dropping next week. It covers the exact step-by-step redemption strategy to get the most value out of every point you've already earned. You've done the hard part. That video will show you how to cash it all in. I'll see you there.